Your voice changed, Sasha. Well, good morning. Hey, good morning, everybody, and welcome. I'm Robert Tiffin, your new MBCEA president, and thank you for joining us today for the first MBCEA National Monthly Webinar. We're going to host relevant and various topics through the course of the year, one per month going forward. We're energized, actually, to be offering these free webinars to bring to each of you, the MBCEA members, and to create an opportunity for those members to gather together, potentially as a starting point for a new local or state chapter. If you'd like to know more about these monthly webinars or have a great idea for one, call me or reach out to Sasha via email so that we can coordinate that. But without further ado, I'd like to introduce our guest speaker today, Dr. Eugenio Aleman. He joined Raymond James in 2022 as the chief economist. Prior to joining Raymond James, Dr. Aleman was the chief economist at the U.S. Department of Energy's Energy Information Administration, EIA. I know we're all used to acronyms. Prior to the EIA, Dr. Aleman was with Wells Fargo for 16 years, first as a director and senior economist for Wells Fargo Securities, where he covered the U.S. domestic consumer profile, contributed to the analysis of the global economy, and researched the commodities, energy, and metals markets. In 2019, he joined Wells Fargo Bank as a vice president and international economist in the corporate economics group. Dr. Aleman has been a professor of economics, at multiple universities. He holds a bachelor's degree in political science from the Universidad de Salvador in Argentina, an MBA from the Inter-American University in Puerto Rico, and a master's and a PhD in economics from Florida International University. Dr. Aleman, a pleasure. Thank you for joining us. And by all means, take it away, sir. Thank you.
Thank you very much. Thank you, Josh. Thank you, Robert. Thank you, Sasha. Thank you, everybody, for being here. Happy to be the guinea pig on this series. So I'm very happy for that. I hope that the information that I provide will help. I think that the U.S. economy is still doing relatively well, actually much better than what we were expecting. If we look at what has happened to the U.S. economy over the last couple of years, and we received the latest information for the last quarter of last year, earlier this morning. This was the preliminary or advanced number, which showed that the U.S. economy grew at a very, very fast pace, 3.3%. It is a little bit down from the 4.9 breakneck pace that it had, or it recorded in the third quarter. But it is important to note that the U.S. economy's potential output, that is, given all the resources available to the U.S. economy, the U.S. economy cannot grow more than 1.9% without relatively serious inflationary pressures. So you can see what has happened over the last 2 years. The U.S. economy has been growing way ahead of the 1.9%. For the whole of 2023, the U.S. economy grew at 2.5%. So that means that it is still growing much higher than what would keep prices contained. Yes, and you can see what happened over the last years after the pandemic, when GDP dropped by almost 40% during the second quarter. I mean, during the quarter that we closed, second quarter of 2020, when we closed the economy because of the pandemic, then rebounded almost as strongly in the following quarter. But if you look at what has happened since then, with the exception of 2 quarters in 2022, which were very weird, the U.S. economy has grown above potential ever since. And this is a concern not because growth is not good, but because inflation has the potential to remain higher than what the Federal Reserve is expecting. So this is something that will keep the Fed in a defensive position. We expect the Fed to start lowering interest rates by June of this year, even though the markets have already said that or assumed that the Fed is going to start lowering interest rates in March or April. We do not think that that is the case, but anybody can make their own estimates about that. You can see that the U.S. consumer has been very, very strong coming out of the pandemic, and even after the pandemic, when things started to come back, you can see that consumer demand. Remember, personal consumption expenditures, or PCE, is about 70% of GDP. So if the consumer is very strong, as it has been lately, that means that the U.S. economy is going to remain strong. So consumer demand grew considerably during this last quarter and overall during the whole of 2023. So the consumer is very strong. The U.S. economy is very strong. So why is the consumer very strong? And I make a joke about this. Look at this. This graph shows real personal disposable income, which is the bluish, light blue line, and then real personal consumption expenditures, which, as I said, are 70% of GDP. You can see here, during the Great Recession, this was the fiscal effort made during the Great Recession to minimize the effects of the recession. Yes, so this was some checks that were given, some monies that were given by the federal government to try to contain the effects of the Great Recession. Not much was done, and the recession lasted for almost 2 years. You can see the depth of the recession wasn't that bad, but the length of the recession was very, very long. Then there were some, just for comparison purposes, there were some changes to tax codes. Capital gain taxes push companies to pay dividends ahead of the increase in taxes at the end of 2012, and that pushed real disposable income much higher. But look at this. This is what we did during the pandemic recession. Yes, this was all a fiscal effort that pushed real personal disposable income through the stratosphere. And basically, this is one of the reasons why inflation was so high, correct? At the same time as consumption collapses, we get trillions of dollars. Remember, the debt during those 2 years increased by almost $7 trillion. So that just gives you an idea of how impactful was these transfers to individuals and firms during this period. I mean, remember, we had the $1,200 check issued by the Trump administration in April of 2020, then the $600 for everybody in December of 2020. Then, because Biden didn't want to be less than Trump, he sent us a check of $1,400 in March 21. Then we had $600 extra per week. Not we, I mean, those who were in unemployment, collecting unemployment insurance, they got for sometimes an extra $600 per week during the pandemic. And then we had PPP loans that were basically not loans, but they were giveaways to firms, company and firms. Okay, I am reading one of the questions, and that is a good question. You know, nobody knows why Americans are so depressed. I mean, what they are doing with their pockets is very, very different than how they are feeling. I mean, some argue that it is because of inflation. Inflation has been very high for the first time in 40 years, and that has pushed Americans to feel that they are not keeping up with inflation. There are some argue that is because of the issues in the political system and the divisions in the political space. I mean, I think that there is some truth to almost every argument. But I get people say, "Oh, I don't spend in Walmart because they treat employees bad and they don't pay employees." You know what? I mean, everybody goes and buys in Walmart because they are cheap. So even even those who say that they don't buy in Walmart are probably buying at Walmart. So what we do individually is very, very different than what we say in general. So I tend to take these qualitative indices with a grain of salt. Incomes are doing well. You can see because inflation is coming down, and employment has remained strong. So you can see that income was weak after the pandemic, but it has started to move higher. So in principle, consumers should feel better, but I see the numbers and I see that they say that they are not better, even though the Michigan consumer sentiment number in December was very good. I mean, it was the largest increase in several decades. So people are starting to feel a little bit better, and hopefully those indices are going to start looking better. I mean, the second question is why people say that they cannot get to the end of the month. I think that because people have gotten used to spending. I mean, you can cut expenditures because we have done it before and we have survived. So, people want to keep their consumption stable. They don't like to give up. I mean, they don't want to stop paying Amazon Prime. They don't want to stop paying for Netflix. They don't want to stop paying for anything, for their cell phone. So, I think that it is not that they cannot adjust their consumption patterns. They don't want to. They feel that they are entitled to continue to consume at current rates. So let me show you this because I don't want to take too much time. So this is a very long inflation graph, and it shows you other periods during which inflation was very high, the 60s, late 60s, 70s, and 80s, or early 80s. And you can see that inflation was very high. This period was called stagflation. Why? Stagflation is a combination of very low growth and very high inflation. So very low growth because we were growing at about 2.4% during that period, but we could have grown at about 4% during that period. That was potential output back in the 70s and 80s, early 80s. Why? Because potential output is calculated with the available resources to the country at that time. Population, which is the most important labor force, the most important resource, was growing very high. So that's why we could grow at 4% back then. Compare that to today. Potential output, because population growth is so slow, we can only grow as much as 1.9% without putting excess pressure on resources. And we are growing at about 2.9%, correct? So that is helping to keep inflation high or to push inflation much higher than what the Fed wants. Okay, so let me see another question. Okay, so construction companies in Houston are predicting a recession. We also are predicting a recession. We are not predicting a very, very deep recession, very, very mild, almost, I mean, people and companies will not even realize that there was a recession during this year. And the only reason why we are expecting a recession is because interest rates remain very high. I'll go back and answer your question regarding the construction industry because I have several slides. But I just wanted to get out of this. So today there is no stagflation. I mean, this is normally what happens when the economy grows too much. Correct? Inflation. I mean, we are growing too much. In terms of GDP, that's one of the reasons why inflation is so high. We are consuming too much, and because we are consuming too much, then inflation is higher. It's not because there is stagflation. And you can see what happened and what happened back in the 70s and 80s and what is happening today. And let me tell you, these two lines. One is inflation, the light blue, and the dark blue is real money supply. So we take nominal money supply and discount inflation, and you can see that every time that inflation goes up, then the Federal Reserve lowers growth rates of real money supply in order to bring inflation down. This is the same thing that is happening today. You can see this extreme increase in money supply during this the pandemic period. Yes, in real money supply, correct? This was not because banks lend money to the economy. This was because the federal government issued checks to individuals and firms. And that is what pushed money supply through the stratosphere, growing at about 25% at the peak on a year-over-year basis. So the only solution to inflation is to bring real money supply to negative territory, which is what the Fed is doing today. By increasing interest rates, they are preventing lending from happening, and they are buying time until everybody gets rid of their excess savings, and the economy goes to a more stable environment in terms of prices. There is nothing bad with this. This is what happened back in the 60s, 70s, and 80s. This is going to be the path for the Fed until they start lowering interest rates. At that time, then we will start seeing real money supply going up. But this is the problem that I see, and this is why I disagree with markets. Markets think that the Fed is going to start lowering interest rates in March. We are not convinced about that. One of the reasons is the Fed has a target of 2% for the rate of inflation, not for the consumer price index, but just as a proxy for the rate of inflation in general. In order to bring inflation down to the 2% level in 1 year, we need to be, I mean, inflation cannot be higher than 0.15%. I'm really bad at this, but okay. So in between this is where inflation has to be between 0.1 and 0.2 per month for a whole year in order to bring down inflation to 2%. We haven't done that on a sustainable basis for many years. So unless the Fed is really, really sure that that is going to happen going forward, they are probably not going to start lowering interest rates. Why? Because if you lower interest rates, banks will start to lend money to individuals and firms, and that could jeopardize their ability to bring inflation further down. Okay, and let me show you. I mean, I am one of those that want to adjust economic variables, but from nominal to real values. So you can see that the darker line, and this is lending in the US, the darker line is total lending. The lighter bluish line is real lending. So you can see that real lending is not growing, almost, is growing very slowly. So banks are not out there lending like crazy, as it was the case during the pre-Great Recession, correct? During this period, lending, so this is nominal lending, but nominal lending is not the issue. The issue is, if we discount inflation, how much lending is actually growing in real terms. So real lending is not growing almost at all. And you can see that auto lending in real terms is not growing very much. And mortgage lending is very, very weak. The only thing that is actually happening in the lending market, where banks are lending a lot, and that is a big risk for the Fed, is credit card lending. And you can see how nominal as well as real credit card lending is growing a lot. I think that is one of the biggest concerns for the Fed. They don't want to put more gas into the fire. They don't want to lower interest rates, because then credit card interest rates are going to go down, and then this could push credit card lending even higher, much higher, and that is what could bring the economy down. Remember that credit card lending is unsecured credit, so firms have an issue if individuals lose their jobs, they cannot pay their credit cards. These are credit cards that are unsecured, and at the same time, they command the highest interest rates, north of 25% per year. So this is what the Fed is looking at. This side of lending, of the credit market, they don't want this to continue to increase. They have started to see some declines in the last couple of months in real terms. So this is good news. They're going to stay put a little bit more so as to prevent these numbers from increasing further. And they have tightened lending standards. You can see very clearly, even though they have come to stabilize over the last couple of months, but credit standards are tighter today, which is what the Federal Reserve wants to do. Okay, so why are consumers consuming so much? Well, one is employment is very strong, and you can see the 3-month moving average of employment growth. Very, very strong. It has slowed down at the end of last year, but it's still very strong. Remember that the US, on average, can create about 125 jobs on average. We are still at 175, 150, 175,000. So very strong labor market, which means very strong growth in salaries and wages. Yeah, so I think that Americans feel that they are invincible right now, that they can continue to borrow, they can continue to spend, and things are going to be great going forward. Of course, as employment starts to deteriorate, this picture is going to change, especially for credit card borrowers. Okay, so interest rates have gone up considerably, even though we have seen that mortgage rates have come back down by more than 100 basis points. That is good news for the housing market. That is good news for investment. But one of the reasons for that is because the yield on the 10-year Treasury has gone down. And you know that mortgage rates reflect or follow the 10-year Treasury up and down, and that this is what has been happening. So The construction industry is still, normally the construction industry is the one that falls the fastest when we have higher interest rates. But you can see that this graph, especially in manufacturing construction, that hasn't been the case. Manufacturing construction spending has boomed over the last 2 years. Why? Well, basically because of the CHIPS Act, lots of new plants in chips that are being built across the U.S. Lots of new plants of electric vehicles and batteries also. So that this has prevented construction, especially in manufacturing, from collapsing. And that is good news. It has stabilized. We don't see continuous growth, but the money allocated for the CHIPS Act, the IRA, and the infrastructure still hasn't been used. So we expect the construction industry to remain strong, even with very, very high interest rates. And you can see up to middle of last year, multifamily homes construction was booming. And single family homes were collapsing. Now we have seen some very small increases in single family units, and then a collapse, not a collapse, but very, very strong declines in multifamily construction. So I was talking to some of in the industry, and they said the cost of production, input costs have come up considerably, very, very, very high costs, so they cannot afford to continue to build at these rates. So we'll see what happens going forward, but this is what is happening in the housing market. And you can see the housing market, how it has reacted to higher interest rates. New homes, existing home sales have plunged. New residential sales are a little bit stronger, but they are also coming down. Let me see if there's another question. How much of that growth was the Amazon effect? I don't know what the Amazon. Oh, the Amazon for construction of distribution sites. If you can answer the question online, I will appreciate, and I can talk about that. Then housing home prices are increasing because the supply of homes is so low that it has pushed prices higher. This is a risk for the Fed going forward. Why? Because home prices basically take a year and a half to affect inflation. Correct? Just because you do not, renters do not sign rental contracts every month. They have to wait 1 year or 2 years, depending on the contract. So that's why it takes a long time. So if home prices started to increase by mid of last year, in 6 to 9 months, we should be further upward pressures on inflation from home prices. Yeah, it could be affected by Amazon. Amazon is very, very large and is constructing lots of distribution centers in cloud storage, and it's one of the biggest participant in that market. But it is also, I have seen segmentation of these numbers of manufacturing construction growth, and it's fundamentally on the if I recall correctly, it's fundamentally on the chips, new construction of manufacturing sites for EVs, for chips, for computer chips, and so forth. Yeah. Okay, so this is the ISM Manufacturing Index, which has been in recession. So recession is measured by any number below 50. So any number below 50 shows that the sector is in recession. You can see that that sector has been in recession for more than a year and a half or so. About 15% of the US economy is the manufacturing sector. So that sector is in recession. Still is, again, it's 15%, but it's very important because it commands very high wages or salaries for those who work on the sector. So that is why it's very, very important for the US economy. The rest of the economy is weaker, but still expanding. So services side of the economy, again, any number above 50 means expansion. The service side of the economy has been expanding since the recovery from the pandemic recession. Even though we have had very, very weak numbers, very sporadically, these numbers continue to be very strong. The biggest or the most positive news, and this is one of the things that can let's say, make our forecast about a recession not correct, is that household debt as a percentage of disposable income is in great shape today. I mean, you would say, okay, it's at 90%. How could that be good? Well, look, I mean, in comparison to the pre-Great Recession level, we were at 123%. So we are in much better shape today. But the important thing is that what we pay for that debt is very low, correct? So this is household debt service ratio. So before the Great Recession, we used to pay about 11% of our incomes in general, correct? This is an average of American households. It's not the scenario for everybody. It's just an average for all of them, correct? But today, that number is at about 8%, correct? So much better shape. One of the biggest reasons for that is because mortgage debt service ratio is at a historic low, almost at about 4%. And this is our biggest concern. Again, credit card borrowing or debt service ratio for credit cards, that is the only one that has been increasing considerably, and that is of concern, especially going forward. So I think that the Fed is looking at these numbers, and if we are wrong with a recession call, this is one of the biggest reasons why. Even though consumers are borrowing a lot, especially in credit cards, their financial situation is still in very good shape compared to previous periods in American history. So this is the only caveat that I have. This is one of the reasons also that we see very, very weak, a mild recession coming to us next year. This is one of the indices that we put a lot of importance in. This is called the leading economic index or leading economic indicators. And that number has been showing recession for more than a year. Every time that has happened, we have had a recession. And this is one of the reasons not the only reason, but one of the reasons why we still are calling for a recession, a very weak, mild recession that will be almost undetected. Or, I mean, let me show you this. We are expecting minus 0.6% growth rate or decline in the second quarter and minus 0.7% in the third quarter. But if you look at the year overall, we are expecting a 1.3% real growth in the U.S. economy after a 2.5% for this year, for last year. So in general, this is good. I mean, from the point of view of an average American, population growth is growing at about 1%. So if the U.S. economy grows at 1.3%, assuming, and this is a big guess, if that everybody's getting their share of the growth, that we will be better off anyway next year, even with a mild recession. So I think that is it. You can sign up or send us an email for our economic releases. By the way, we have the start of the Fed lowering interest rates during the second quarter, at the end of the second quarter of this year, June, to be more exact, and then go 3 times more by the end of 2024. So we'll start 2025 with a Fed funds rate of 4.25%, and then they will continue to lower. And you can see that inflation, while it is expected to hit or to start to hit 2%, it will not be 2%. So they will need to make an effort to make it 2% in 2025, and that's the reason we think that they will continue to keep interest rates relatively high, but on a downward path during the rest of the years. So again, you can sign up for our email distribution list. We produce a weekly commentary and some indicators almost every day. RJ Economics are at raymondjames.com, and we'll be happy to, and I'm going to the chat again to see. Okay, so let's see the next question. Okay. So I have a question also for the commercial construction material cost still has more than double in cost. I budget still building times 2.5 from historic budget. Square feet cost, $10 square feet building is now seem to be leveling off, though still has come down, but prices are slowly coming down due to demand. I mean, there's a lot of risks, and I agree with you. There are a lot of risks out there, and that is why we haven't changed our forecast for a mild recession. I mean, we still think that that anything that happens in the rest of the world could affect costs. This is what happened during the pandemic. We are not expecting what happened during the pandemic to happen again today, correct? I mean, but any one of these events could trigger higher prices. And even though commodity prices are coming down, they are not coming down at a very fast pace. But I think that they will continue to come down. I don't know the specifics of your industry. I will have to research them. But I have heard that costs in the construction industry have skyrocketed, and that could be putting further pressure on construction for that industry. What I do know is that there's plenty of money coming from the federal government that could kind of balance the extra costs out. especially if you are involved in this construction that is occurring in these sectors that are being promoted by the federal government. So I still have a positive view of the economy, even though we are forecasting a mild recession. So Sasha, I don't know if, or Robert, I don't know if there are questions or anybody wants to talk about it, or I mean, I have tried to answer the questions in the chat as most as I could, but if there's any interest in engaging, I'm here.
Sasha, did anybody else reach out to you directly with questions?
Nope, nothing else in the chat. So please feel free to continue to put things in the chat. Robert is going to share some of the regional outlooks that were presented to us from our chapter presidents. And if you have any questions throughout, please feel free to put them in the chat.
Perfect. Dr. Aleman, while I'm just sharing some of these things out, if you wouldn't mind putting your screen back on with regard to the question or to your email address so that people can sign up for your releases, that would be fabulous. So one of the first ones, so from the Pacific Northwest, from Dan Halme and the Western chapter, now reminding, I am not an economist. I am not an economy expert. I am a consumer, as are the rest of us. And I will say to this public forum that, yes, I do shop at Walmart. Anyway, the summary from Dan was, from the Pacific Northwest, there are significant signs of showing. The recession looks like it is imminent for several quarters this year, so that aligns with Dr. Aleman. Interest rates remain higher, stagnating some new starts. The decline should not be as devastating, but highly noticeable, and then expect a good recovery going into 2025. So maybe we should have read Dan's before, because that's a total precursor to what Dr. Aleman said. So there was, we talked about some of John.
I think that I pay him to say those things,
to
to agree with me.
Perfect.
So here's the email address, rjeconomics@raymondjames.com for those who are interested.
Perfect.
And there are two. How population growth is measured. Yeah, I mean, the U.S. Census calculates population growth. And I mean, they have a model that calculates births and calculates deaths per year. And they net it out, and that is what population growth is. There are revisions over time, as in any economic indicator. But I mean, our growth rate of population is the highest of any developed countries. And that is good for us, but it's not as high as it used to be. Back in the 60s and 70s, it was about 2%. Now it's about half of that. So that is where we get the numbers. And I mean, of course, these numbers are shared with everybody. So they're public. Do you think that the migration scenario playing out in the US right now impacts the analysis? Yeah, I mean, one of the reasons why labor costs are slowing down in the US is because immigration is, people are coming back in. I know that it's not an easy topic to talk about. There's a lot of political ramifications of this, but you know, I mean, one of the reasons that we have, as a country, we have to figure out what to do, because we need people to work, and we need to solve the legal immigration issue, because that sector, that system is broken. And that is one of the reasons why people are doing it themselves. Why they're crossing the borders, because it is almost impossible to get authorization to come in. So, I mean, a managed immigration process would be good. I mean, companies should be the first lobbying the government to try to fix the system, because the system is broken, and until we don't agree on what to do with it, it is going to be very difficult. I mean, the good news is that AI is coming, and according to many, they are going. All our jobs are at risk, so we might not need that much immigration. But that is a long-term prospect, and I don't think that AI has the charm that I have. So my job is secure. I hope.
So, if you don't mind, I'm the one. This is Josh Pointer. I'm the one that put those couple questions in there, and rather than try to figure out how to communicate it in a typed form, I figured I would just jump on. I don't disagree with anything that you just said, but I guess my question is more about the math. With the understanding that we don't really have a way to measure how many people have come across the border. We have some measurement, but we know it's not everybody. The question that I have in my mind is, you related the idea that, population growth is a direct impact on economic growth and how it relates to inflation. So the question is, just knowing the numbers that we do know, is that enough to have a material impact on the economic analysis you provided? Because as you said, if the measurement is what the U.S. Census Bureau is using as their numbers, those obviously don't account for at least a large majority of those folks that have come across the border. So I'm just trying to get a sense of how that might impact the analysis at all.
Yeah. I mean, when the federal government does their surveys, their employment survey, they don't ask whether you are legal or illegal in the U.S. So illegal immigrants are actually counted.
Okay.
Assuming
they respond.
I'm sorry.
Assuming that they respond, there's a good number of them that
they don't speak. They don't speak English.
There's a lot of Americans who won't either that are legal.
Yeah. So basically, I mean, the surveys are conducted from a sample, correct, of the universe. So they take a sample of the universe of the U.S. and they call on that sample. The sample is supposed to be representative of the universe. And that sample is normally improved and changed according to the characteristics of the universe. So in principle, in statistical terms, any influx should be counted. I mean, we have seen a decline in, an improvement in the participation rates, and and that is probably the reason why we have with certainty we can say that immigration has played a relatively important role in improving the labor scenario. And let me tell you something. I mean, I am impressed about the ability of, the job market is weakening considerably. One of the reasons why I say that is because the U.S. government has been hiring like crazy. Not the federal government. State and local governments are hiring the 99% of all workers in the U.S. government. And the reason for that is because they were priced out of hiring after the pandemic, because everybody was trying to get people back to their companies, and they had to increase wages and salaries to bring them back, and the government could not compete. So now that that pressure has come down, of course, every industry is different. and the construction industry has been very strong. So it hasn't, I mean, I was talking to somebody in the construction industry that told me, look, we normally have construction going on, and then we finish, and then we lay off people. We haven't been laying off anybody, correct? And some say that firms are hoarding workers. Come on, why would you hoard workers? I mean, it makes no sense, correct? But the reason is that you have more work. So you finish one and then you hire them again, or keep on them on the payroll to continue to work on next projects. So, I mean, all this data is bound to be revised over time because the samples change, the universe change, and you have to revise all these type of things. And the federal government does a good job of making what they call benchmark revisions to this data. So, why lies are bad? Because you have to be consistent over time. If you start changing your lie, then everybody figures it out. All right. So this is the good thing about statistics. If you were lying before, then if you continue to lie the same way, the series is correct. When it is not correct, is when you lie differently every time. And there are statistical ways to show that you are lying, which is one of the good things about statistics. Even if it is, if we believe that the series is incorrect today, the changes over time are correct.
Makes me think back to my university days when our professor said, statistics don't lie, but you can lie with statistics.
Yes. Yes. Exactly. Yeah, well, I actually showed, I used to cover Latin America, and I statistically showed that the Argentinian government was lying. And of course, the bank did not allow me to publish that, but I actually showed. And then the IMF castigated the government for lying on their statistics. And you can actually demonstrate that somebody's lying with their statistics. And I haven't seen that happening here. So,
gotcha. Well,
if we bump back up, there was a question from
another question.
David. Yeah, there was one from David. As we were looking at Josh's, the presidential elections typically stalemate the economy. Is that what you're seeing for 2024?
I'm sorry, what's the question?
It's the one from David Leinbach. The presidential elections typically stalemate the economy. Is that what you are seeing for 2024?
No, actually, well, so there are people that say the government spend a lot during presidential elections, and it is not that governments spend a lot. The problem is that there's a lot of money coming into presidential elections for campaigns and so forth. So, I mean, even markets, I don't know if you know that markets tend to be very positive during presidential elections, actually react positively to presidential elections, independently of who wins. I think that there are risks, but not something that will derail what we believe it is going to happen to the economy. I know that there are risks. Risks of violence across the U.S. I mean, I was at a presentation 2 days ago where this political analyst said that the poll workers are fearful of going back to being poll workers because they have received threats and they are very, very afraid. So there are risks, as there are whenever we have such a polarized political system. But I tend to be positive on the political environment. In the end, it's just two political parties. Everybody wants to be president and want to be in power. So it's it should be a normal process. I don't know why we make so much out of it. I mean, I always joke that if you look at history, the Republicans have spent the same amount or more money over time when they have been in power. So, I mean, if you are a Republican and think that they're going to spend less, don't think that that is going to be the case. If you are a Democrat, I think that the Democrats are going to spend less. Believe them, because they are going to spend more. So, I mean, I think that the debt issue is an issue that we have to deal with also. The immigration issue and the debt issue is something that we have to deal with. But I don't trust politicians in general. I don't trust them in particular either.
Well, just make sure you get out and vote. But now we're done. Do you want to touch the
We
last?
have one other question.
Yeah.
Let's see if
Yes.
we can quickly get that one in. It seems there is a little bit of a glut of office space and warehouse space. That, along with construction, seems to be first impacted by recession. Can you see a larger impact on construction with this projected recession?
Yeah, I mean, the commercial real estate market is in trouble. I mean, it has been in trouble since the Great Recession. Yes, if you remember, during the Great Recession, everybody was saying that was going to be the next shoe to fall. It never fell because regulators knew what was happening, correct? And they started arranging solutions between the banking system and the commercial real estate sector. And they were able to keep the industry afloat. The pandemic was probably the second shoe that never fell. It fell finally for the commercial real estate sector because now they have to rethink the whole definition of where their business is. So I think that sector has to transition to an alternative. I think that firms want to go back to downtowns areas and want to go back to the offices, but as long as the labor market remains strong, there's very little power from firms to bring back workers. I mean, workers say, okay, if you make me go back, I quit. Correct? Many companies have faced that scenario. I think that those times are over or are in the process of being over. I think that for the future, the commercial real estate is going to improve, but I think that also that it has to reform itself and figure out what to do with these excess capacity that we see in the sector. So I think that it's going to improve, but very slowly.
Perfect. Well, Dr. Aleman, thank you very much. This was fabulous.
My pleasure. Thank you for having me.
Absolutely thought-provoking. And for everybody that paid attention, added questions, we will calculate that. The recording will go out. I'll summarize the anecdotal from the chapter presidents. And if you have any additional questions, feel free to email them to Sasha, because this clearly is our industry and our go forward for 2024. So for the balance of the day, thank you. Y'all go be safe, and we will see you next month with our next one on temporary bracing. And again, Dr. Aleman, thank you very kindly, sir. Appreciate it.
Thank you. Thank you for having me.
Thank
I'll
you.
send you Josh, I'll send you the presentation so you can share it.
Okay, great. Thank you.
Perfect.
Okay.
Thanks, everybody.
Thanks.
Thanks, Josh.
Thank
Bye.
you.
Thank you, guys.